Cotta and Liz Ann Sonders talking about markets today. Oil price is probably the biggest story of global markets, right? Now we see the negative implications with all these oil companies lowering guidance, cutting jobs. What's your observation of the price of oil? How does that impact investments?
So, there's a lot of look back to periods in the past where we've seen this big a drop in a short period of time, more than 50% down in the past 6 months. And it happened in '86 and it happened in 1991. And I think '86 is a good example in that it didn't kill the market, it didn't kill the economy. But I think '91 is maybe a better example because the S&L crisis started in Texas. So you saw the beginning of what turned into a bigger crisis emanate from the problem in oil. I don't think it's a problem for the economy. I think it's a net positive for the economy. But obviously, it's a big negative for the energy part of our economy, whether it's jobs or capex.
Well, I mean, I was sort of very taken aback when I read that much of the job creation just from 2007 has been coming out of Texas and the job creation around the shale revolution and the energy boom. Mark.
So we're down in Dallas, Texas, and certainly we have a pretty close front seat to all of this going on in the oil space. And I would tell you that it has been very accretive to our economy. It's been good. But there's a bigger picture here that I want to talk a little bit about the oil price. So, when we got up to that $100 spike back in June of last year, what was going on within the futures markets with financial players who were speculating on the price of oil? We got to about 550,000 contracts net long. That's 2.5 times the average. So we've had a big unwind of those positions, and that financial pressure has pushed it way down. Now, you talked about '86. So oil at that time was about 15% oversupplied. Today, we're only about maybe 1 or 2%, depending on how you look at it. So oil in the margin is very tight. So we can move a lot in this kind of environment just by a small sort of change in supply and demand. And so oil is getting very volatile in here. How do you play that? We think that it's early, right? To your point about where are these earnings going to show up through the whole system, and so we're doing higher quality things in the space. Anadarko is a good name. There's some nice names that have been beat up a bit in here, but we're not making a call on energy prices yet because I think it's early. I think there's going to be a lot more volatility.
You've got a valuation story that's a lot more attractive than the broader market.
Absolutely.
I mean, is that something that you want to look at, Liz Ann, when you look at energy as a sector to own? Are you ready now?
No, not yet.
Not
and
yet.
I think there is value. But if you look at the last time we saw this type of move in the commodity as well as in the stocks, you're at a steep level of contango right now in terms of the price of oil. But the last time you got to about these levels, you still had a bit more to go, and the energy sector still corrected more on a relative basis. So it's hard to exactly pinpoint the bottom. There's absolutely value there, and I think there probably will be value buyers that are starting to step in. But I still think you're in that, catch a falling knife kind of environment.
I had Prince Al-Walid as my subject in my USA Today column last week, who was very adamant about we will not see $100 barrel oil again. Now, one of the other implications of that, he said, is, number one, you're going to see mergers. You're going to see lots of consolidation in energy. And you're going to see a bust of the shale revolution, which, to me, is a negative for the U.S. economy.
I'm not so sure you see a bust of the shale revolution. I think you probably see a bust of some of the marginal players, which is in conjunction with M&A. You've certainly you're seeing the fractures in the high yield market, debt taken on to fuel this additional production. And I think you do weed out a lot of those more marginal players.
That makes sense.
I'm not so sure the industry disappears.
That makes sense.
Yeah, I mean, there are certainly players within the space that are very good at lifting oil at very low prices. And shale has a much different speed than, drilling miles down into the ocean. So the rig count's down big, right? And there's a lot of adjustments. But, we talk about what do you do in this space as an investor. There are things that we see that are great value, that we're not too worried about catching a falling knife because we've got great asset coverage. In the credit space, you can be secured against some of these assets that have very long lives and a lot of cash flow, and you're not really worried about the price of oil per se. And so there are things to do within the space, but I agree with you, Livian. It is early. We're going to see some vol here, and there'll be time to get both long and short in this space, and so we're kind of excited about that.
Well, volatility, obviously what we're living with for 2015 so far. Let me move this closer to what we were talking about with earnings, because the energy space is going to be one of the underperformers in terms of fourth quarter earnings, given the price. Banks have been unimpressive. This bank stocks have been trading down on their earnings. How do you characterize earnings for the fourth quarter? And I guess more importantly, what's priced into the market, and what sort of is going to be a surprise to the market?
Analysts have been dealing with this in terms of cutting estimates, obviously for the energy sector. To your point about financials, I think there is a concern about some of the ripple effects from what's going on in the currency markets, as well as weak global growth. And then also the strength in the dollar, I think, has analysts a bit concerned about earnings for multinationals. So as a result, the bar has been set pretty low. We're really only just in marginal growth territory in terms of the next quarter's earnings estimates. I do happen to think, though, we will repeat what we've been repeating, which is that the bar gets set too low, and ultimately we get to earnings season year a little bit better.
Because right now, Mark, S&P Capital IQ is talking about earnings growth for the fourth quarter of 4.9%. It's okay, not great.
Sure, that is going to be the case, but we have to start to look forward, right? We're not to look back. And when you have this kind of move in oil, in the Swiss franc, in the euro, in the dollar, you're eventually going to have winners and losers through the space. That's going to get reflected in numbers. If you look at the airlines, for example, you've got some are hedged, some aren't.
Yeah, that's true.
That really changes the playing field, and so it goes back to this theme of active management. I don't want to harp on it per se, but it's hard for me to sit here and say, okay, everything's going to be rosy again, because it has been.
Right.
I think what's going to be the case is we're going to see much more dispersion around winners and losers in the space, and it's more about calling that than calling the overall environment. Now, I'm not a bear. I'm not saying that I think we see the stock market correct 15% and we're in this doldrums and forever. I just think that we're going to have volatility.
All right, we've got to get your take ahead of the Thursday. It's supposed to be a big day with the European Central Bank. I want to find out what kind of implications any stimulus would have on the markets. But meanwhile,